What's up, YouTube? It's Joe Catapaglia sitting on the couch, making some money investing in fractional real estate online, as usual. Yesterday was dividend day on Mogul. We received our December dividends. There was also a webinar and a property launch, so a lot to talk about with Mogul. In this video, I'm just going to go over my portfolio returns, but I am going to get into, hopefully tonight, I'll be able to dig into the new property and share some thoughts on that as well. So we did have a nice rebound in dividends. I received $99. Definitely not my highest dividends received to date. But it is, okay, where is that? Let me see. It's actually 98.54. What are my highest ones? Let's go back. Yeah, 155 I think is the highest. But we're a good way of the ways back. There's some, really overarching themes as far as STRs versus pad splits. All the STRs are suffering for basically the same reason, it sounds like. It's pretty thin discussion. My overall portfolio right now, annual yield was 6% last year. Significantly below, their stated yields on a portfolio-wide basis. If I broke out just my pad splits, I'd be, I believe, somewhere around 10%, maybe even better, annualized. It's kind of tough because, my investments didn't all happen at the same time. And so to weight them properly was a little bit more work than what I wanted to do. But across the board, my pad splits yields have been pretty strong. I only have a few that are lagging a little bit. Several of them are outperforming. But my short-term rentals are all significantly worse than expected. And so let me jump into each individual one. If you remember, the first property I bought, and that's what really dragged down those numbers quite a bit. The first property I bought was the Axelrod. I didn't realize how often they'd be putting out properties, so I thought, I might buy 4 or 5 this year. I actually bought 16, and so it was my largest investment. I bought a $5,000 chunk of it. And it's one of my worst performers. My annual yield, it says 5.12. It's actually lower than that if you did real math. One of the things they're doing is in the months with negative, where we can't cover the debt service, where our cash flow would actually be negative, they're just pulling that from the reserve. They're not paying us anything out of it. I mean, they're using the reserve for what it should be, but this calculation is not taking into account the negative cash flows in this month, right? It's showing a 0 yield. And so my actual returns on this one, if you were looking at it, this is really a true cash yield to me from the investment I put in and the cash I've received back. But it's only, by virtue of there being this large reserve to pull from that this wasn't actually a negative cash flow. That's my only point. I won't keep mentioning that on each one, but a lot of the short-term rentals, that's a problem. The roads, this was the first short-term rental I bought. It was in Mesa, Arizona. No, the first pad split I bought in Mesa, Arizona. I wish I had bought a whole bunch more of it. You can see annual yield last year, 12.78%. I owned it basically the whole year, and so it was a fantastic performer. There was a little bit of variation over the months, but in general, it just really, you just have to do this. In general, it was just stable, and it did well the whole way. February was the only a little bit of a dip from January to February, but you can see really double digits every single month. So that one was fantastic. If they do open up a secondary market, which one of the things they mentioned in the webinar is now it's not the second quarter, which I really think they had said second quarter of this year was when they expected. They said they think it'll probably be by the end of the year if they're able to do it this year at all. Something like that. I'm not quoting them exactly. I think they need to get to a larger scale because they're planning to be, that they're going to be the market maker when they open the secondary market. So they're going to provide the liquidity. They think they need to be at a certain size in order to get a line of credit to be the ones that do that. Something to that effect. I think it's good in that you won't see prices tank if they're willing to buy them back at what they think is fair market value, value of the underlying asset. So I think that's going to be good for all of us investors. once, it's not great that it's going to be at least a year from now, maybe longer. But I think it's going to be good if the way they want to do it sounds smarter than what we're seeing right now. Of course, it will mean we're not going to get big discounts. All that to say, I just was bringing up the secondary market because I would buy a whole bunch more of the roads if I could. Hopefully that opportunity, comes up. The WAGs, this is a short-term rental in Houston, but this is the one that has the title insurance claim going on. They said we're just now waiting for the decision that it was, I want to say it actually went to court, not just that they filed a claim, but I'm not 100% sure. But they are just awaiting a decision. And then hopefully this will be resolved. I think that what's going to happen is we're just going to get our money back. I'm not 100% positive what's going to happen, but I think that's what's happening there. Although there was revenue, and so that confused me a little bit because I thought that the property was taken back, so it wasn't completely clear to me. Well, let me see. Oh, the listing is back up with rental income reflecting just one booking. They're pursuing a settlement with the title claim mentioned. Anyway, that doesn't sound the same as what I thought I had heard on the webinar, but I guess I could just be wrong. I do believe that, based on the situation, that we will be made somewhat close to whole, if not whole, through the title insurance. But what that looks like, whether that means we get, they get the funds to pay off that other lender, and then we actually just own it as a short-term rental, or we just get paid back, I'm not sure. I mean, the fact that they have the listing back up makes me think it's the former. The whole time I had been assuming it was going to be the latter. So I'm not sure what's happening there. It would be great if the property page, if it just actually, outlined what was going on, or somewhere where it was a little more clear. Although those of us who own it, we have received emails at different points in time that said, "Hey, this is what's going on." But I love more regular updates on the exact situation. The Mafee, this is another. This is a pad split in Decatur, Georgia. It's another one that's done very well for me. A little bit of a dip. Let's see, last month was really where we had the larger dip, and then coming back a little bit, but annual yield last year 9.4% for me. That's fantastic. Really, anytime I'm getting over 7 or 8%, I'm really excited. So this is one of the reasons why I keep saying, oh well, they're newer deals. They're just not like their old deals. Like if you look at a lot of these older pad splits, they just had such fantastic yields. The Johnson, which was another short-term rental, this one in Austin. Also, let's see, also not covering its, not enough, it's negative cash flow after debt service. And so, again, something else that's dragging down the portfolio. The Celeste is another one, right? Another short-term rental in Houston. All the short-term rentals aren't doing well. Now, they said, this is just, only 42% occupancy, low demand, and lower ADR. It is the only one that I think it's the only one that I bought without a pool. And at the time, I only did it because their historical numbers were so strong. But, it's sometimes when you have these rules, like I only buy short-term rentals with pools, when you're tempted to break them, maybe you shouldn't. I don't know. I mean, sometimes I break my rules and I'm happy about it, but obviously that's one that I'm not tremendously happy about. Let's see. Yeah, winter season. I mean, the short-term rentals, partially it's seasonal, but I don't think that's the whole story. Because they did mention, let's see, with the Axelrod that their former revenue manager it was performing poorly. So it sounds like that they changed it out, with, I mean, it's, they acknowledge, they realize these are not going the way people want, and they're working on it now. How much of it is stuff that's beyond their control, like just macroeconomic stuff, and how much of it is, okay, we can tweak this and, use a different manager or a different revenue manager? I don't really know, but across the board, the short-term rentals are performing very poorly. The Victor, this is another Atlanta, Georgia pad split. And I mean, check out that yield, right? It is, yeah, we had a couple of lower months with the last 2 months, but look at this, 13.53%. So fantastic yield on the Victor. Oh, okay, my little thing froze. Oh, there we go. Let me just see. Yeah, I mean, really, really strong. The Andres, this is another Decatur, Georgia pad split, and right at 10.2% for the year. Yeah, I mean, this is why, again, when I'm seeing all their new listings where it's like, okay, we're going to get 7.9% yield, I'm just really wondering, are they just trying to be more conservative, or they're just not able to find these kinds of deals that they were getting us early on? I'm just not sure what the answer to that is. The Chelsea, this is Atlanta, Georgia pad split. Again, fantastic yield, right? 14.6%. I mean, yeah, it was just fully occupied in December. That's what a fully occupied month looks like. I mean, this is unbelievable. So at least my initial portfolio with them is really strong, and it's why I've been passing on a lot of their deals, because I'm hoping that they start putting some stuff out like this again. I'm just not sure. I don't understand why they were very consistently finding these very strong yielders. Like, has the market shifted that much? I don't know. I don't know what's going on. This is a Douglasville, Georgia pad split. It's the Ratliff. Okay, this is one that has lower yields, and so for the year it ended up at 7.4. What do they say here? Had one vacancy in December, one tenant move in at the end of November. Which, when the tenants move in, pad split charges. I want to say it's for the first 10 days. They charge 10 days of rent basically. The first 10 days you basically get no revenue. That all goes to pad split. So when you have a move in, that hurts you as well. What's going on with that? Hopefully that's working. My little camera thing looks funny today. The Ven, this is another pad split. Little Burn, Georgia. Little Burn, something like that. Yeah, this is another one that isn't doing amazing, I guess. 6.07%. What did they say about that? Fully occupied in December, but had a late November move-in, which affected the profitability. But that's just one, right? That's kind of a little bit concerning, right? With just one. I think this story has been more about, okay, what's going on with our OpEx more than it is. The revenue has actually been strong. So I don't know. I mean, and maybe this is partially what the projections are taking into account, as they realize that this OpEx is going to be a bigger number than they thought for some of them. It'll just be interesting to see as time goes on how they continue to perform. Again, it's why all the fractional real estate sites I'm investing in, it's an experiment, right? I'm not putting a huge portion of my net worth. I want to be able to buy several properties, hold them for a little while, see how it goes. Some of these, it's been fantastic. Some of them, not so much. Mogul, overall, I'm happy with them. It does seem like they need to figure out, either short-term rentals, they need to figure something different out, or maybe they don't have so many of them and they only buy the absolute best ones. I'm not sure, maybe I actually selected poor ones. Maybe I needed to look at how some of them performed that I didn't buy, and see if I just, if I got unlucky, if I just made bad decisions, what's going on there. Before I forget, please like and subscribe. In the description of this video, I have links to all the places where I'm currently investing in fractional real estate online. A lot of those are affiliate links, which means I might get paid something if you invest. You might as well. You just have to read the terms of service when you go to those websites. Please do your own due diligence on all of those websites and on any of the properties that you see me talking about. Just because I invest in something doesn't mean that you should. And just because I pass on an investment doesn't mean that it's not a good deal for you. I'm sure we have different goals. We have different risk preference, different timelines, all that sort of thing. Also in the description of this video, I have a link set up to a Discord channel that has over 200 people talking about fractional real estate investing, lots of different platforms. You're welcome to join that. It's free. It's not a sales funnel. I won't try to sell you investments or services or anything like that. If somebody looks like me on Discord is doing that, please report them to Discord because they're an imposter. There is a lot of that going around. Anyway, back to the portfolio review. The next one is the Hugo, which is the Dallas, Texas short-term rental. And again, performing very poorly. I don't know that I've ever had, no income ever from this one. Now they have some income, but not able to overcome expenses and debt service. And what do they have to say about this one? It was only 35% rented for the month of December. Struggled to rent even with lower ADR and shorter booking windows. Still seeing impacts from the Hugo from the former revenue manager that we are mitigating going into January. So, again, I mean, they've changed revenue managers. Hopefully that works. That's helpful. We'll see. And if you're not familiar with, what they mean by revenue manager versus property manager, and I don't know exactly what they're doing, but in general, in the short-term rental space, you can hire somebody just to handle your bookings and your pricing, and that's typically your revenue manager. And often people hire a different, either a different property manager that is going to do things like fix the problems with the property, like the physical property, interact with the guests and whatnot. Sometimes the revenue manager is like subcontracted through the property manager. Sometimes it's a service that's bought separately. There's a lot of different setups. So I'm not exactly sure what they're doing here. I know they have a third party PM. I'm pretty sure, I don't know about the Hugo, but all the other ones I think that I had were managed by Surge short-term rentals or something like that. So I don't know if that PM is actually changing revenue managers, or if Mogul is handling some portion of it internally and using. I'm not sure. Would be interesting to ask. I didn't get on the webinar yesterday in time, I did watch it after the fact, but I didn't get on in time to ask any questions, which was unfortunate. Hopefully next month I won't be slacking and I'll get some better questions in there. The Pinkman, this is another pad split in Atlanta, Georgia. This was one where we did buy it and have the seller do some rehab for us. You can see, the revenue's been good, but we had some just really large OpEx. But even with that, that made us negative cash flow for the last 2 months. And so even though it says 5.34%, same thing that I've mentioned before. What do they have to say about this, though? Had 2 vacancies filled in December. And so, maybe that OpEx is repainting those rooms or something. I'm not sure. One of the things, especially when we have some larger items, it would be great to know what exactly these are. Because, we had good revenue, right? Like if there wasn't $2,500 in operating expenses, we would have made some money this month. So anyway, the Gilmore, this is another Tempe, Arizona pad split. I say another, it's not, I guess the other one, I have one in Mesa, Arizona, and this one's in Tempe, Arizona. This one's doing fairly well, right? 10.51% annual yield. It's only had, I think this is just these 4 months. I think this was a partial month. This was the first full month, and there was no debt service, which is why it was amazing. But I think we're averaging out. And so this, if we just average this current month, I think it'd be 9% and change. But anyway, doing pretty well, pretty happy with this. They had 2 vacancies filled in December, but it's still actually doing well. So that's kind of impressive. And then the Swift is a short-term rental where in Glendale, Arizona. This was one I was really excited about. I thought it should do well. It is just getting up and running. It was only 39% occupied. Some of those were from the previous manager. And so, I think it's too early to say this one's going to be do as poorly as, the other ones that I've had so far, but, only time will tell. So, and then the Blitzen isn't up and running yet. that's my whole portfolio on Mogul. Like I said, overall, I'm pretty happy with it. 6% yield across the whole portfolio. Really weighted down by a lot of the zeros from the STRs, or a lot of the lower numbers from the STRs, which I think partially the economy. When flights were shut down a while back, that hurt us during some months that should have been kind of better months. Partially seasonality, but also too, I think we're going into short-term rentals kind of are past their heyday, right? And so there's always these like trends in real estate, like where certain investments do well and other ones don't do so well. Now, I don't think short-term rentals are going away as an asset class, but maybe getting 8, 10, 12% yields on them isn't going to be realistic for stuff that we're finding on here. Maybe we are just going to have to be happier with a 6% yield on those types of properties. Maybe that's what's going on with pad splits as well, right? I've mentioned this lots of times. I think that pad splits will probably follow a similar cycle to short-term rentals, where they're fairly new. If you got into short-term rentals early, you made tons of money. People getting into pad splits early seem to be making tons of money. Maybe that learning curve, though, for investors is faster now, because a lot of the short-term rental investors see this opportunity. They know they were late to short-term rentals. They're getting into, co-living in pad split early. And you just see them popping up everywhere. So maybe it is getting saturated quicker. The big difference in my mind is, I think the demand for affordable housing is so great right now that if the model catches on among people, among the actual members, the guests that stay in the properties. I mean, that's the thing. Like, there's this sort of learning curve and hurdle for them, right? They're renting a room, they're sharing a kitchen, they're often sharing bathrooms. But I think there's it's yet to be seen how much of the affordable housing demand will be happy with a pad split solution, right? Or how many of them are like, nope, I don't care if I can barely afford it. I'm going to get myself a regular apartment, and I'm going to get roommates that I know, or do something different, or I'm going to get a 1-bedroom, 1-bath, which is going to cost me a little bit more, but it's worth it. Like, it's one of the things. There's a lot of unknowns in what the future is going to hold. Obviously, we were getting, the earlier deals that we got had fantastic yields. It doesn't look like Mogul's finding deals with those same level of yields today. But over time, like, the Blitzen's the most recent one I bought, and it didn't have great projection. So it'll be interesting to see, if it does, if it is able to perform better than expected, right? Then we'll, in some of the other ones, if they have, then we'll start to get the idea that, okay, maybe it's just conservative underwriting. But if they're really just hitting that 7.9%, that they're projecting, that might be the new normal, because there's so many other people now competing for those deals. I don't know. And, at the same time, the returns on some of these that we already bought might start to erode as more and more pad splits enter the market. That's, it's a risk that we're taking. I'm comfortable with it, because I think, there's only at a certain point, especially in the existing portfolio, it's hard for new people to buy properties and compete on price if prices get bid up because of this product type, which is what we saw a lot on STRs, right? So some of the short-term rentals, a lot of the first movers did fine for longer, until they sort of got out-compete. They basically lost the competition for amenities as people started buying nicer and nicer properties. I think Mogul seems to be going that direction with pad split already, right? Like, they're not just giving the absolute bare bones rooms. They're doing the mounted TVs and the desks, and some of them that are multi-floors have like little kitchenettes on the other floors. Like, I think they're sort of on the front line of where things are going, which could be good. But like I said, only time will tell. That's how my portfolio performed in December and overall for the year. They're still, I want to say they're still my favorite platform. It's disappointing that they had such amazing deals and then they sort of went downhill. Now, obviously, a lot of their early deals didn't live up to the projections this first year anyway. Most of those being short-term rentals, which is surprising because all of them they had, past years of. They were based underwriting based on actual performance of those properties, but I do think it's just the direction that the industry has gone over this past year. I know a lot of short-term rental investors struggling, although with the types of properties we have or that that they've put out that I bought, I expected them to do better. Nice properties with pools in San Antonio are still doing well as short-term rentals. I expected similar in Austin, in Houston, but maybe we just paid too much to make them work. Because each time I did those videos, I did think that you can go back and watch them if you want to, but on a lot of them, it seemed like the revenue to price ratio wasn't quite where I'd want it to be. But it seemed like, the way they did their projections, that it might work. We'll find out. But that's how things have gone so far. And, I no more speculating for me for today. And, I know I got super rambly at the end here. Sorry about that. Always seems to happen. I should just stop videos earlier, but I don't. I don't know. Until next time. I'm going to just keep making mistakes. Oh, if I didn't say please like and subscribe, please do that. Do the thing with the bell. Put some comments and tell me, how did your portfolio do, right? Did it do better than mine? And you can say, in your face, Joe, I did better than you. I got whatever percent. I mean, I think overall you have to have done better than me if all you did was pick up pad splits, because my short-term rentals drug it down. Anyway, until next time, I'm going to keep making mistakes so that you don't have to.